Welcome to Lesson 7. Today's lesson is all about using your income statement to know your worth. Our 3 goals for this lesson are: understand how to read an income statement, use an income statement to determine your worth, and analyze an income statement to continually grow your business. The best way to learn how to read an income statement is to look at an example. My example client, Stephanie, runs a photography business, and here we have her income statement for the first quarter of the year. This income statement tells us a lot of information about Stephanie's business. First up, there's the gross profit, which is calculated by tallying up sales for that period of time and subtracting the cost of goods sold. For Stephanie, cost of goods sold includes things like travel costs to get to photo shoots. If you're a potter or an artist, your cost of goods sold would include all of the raw materials that go into each piece. If you're a freelance writer, you might have no cost of goods sold, since producing your work may just involve typing a document on your computer. Next, there's a rundown of regular operating expenses involved with running the business. These are administrative costs. Stephanie deducts the day-to-day expenses like rent for her co-working space, her part-time personal assistant, her Photoshop subscription, and her project management software. She also deducts costs required for customer acquisition, such as paying for social media ads or purchasing a booth at a trade show. Finally, the total expenses are subtracted from the gross profit to give the net income for the given time period. Like you saw in Stephanie's example, an income statement clearly and simply breaks down your sales, cost of goods sold, and expenses over a given time period. Here are some easy equations you can use when looking at your income statement, and these equations can also be found in our Lesson 7 guide. Now, there are also times when your income statement will include unexpected or unusual expenses. For instance, let's say Stephanie had to make a massive computer purchase that only happens once every 4 years. In that case, her income statement will have an additional section for non-operating expenses and her operating income, which is how much she made before the odd expense. This is shown separately from her net income, which is how much she ended up making. Separating these one-time expenses this way can help you prevent panic, because if your income is especially low one period, you can clearly see that it was from an unusual expense and not a deeper issue with your sales or regular spending. So how does reading an income statement help you? Well, probably most importantly, it tells you exactly how much you'll see in your bank account when all is said and done. This is what allows you to clearly see if you're really making money to survive. In our example, if Stephanie continued earning and spending about the same for the rest of the year, she'd make a healthy $60,000 in sales, but she'd only end up with $33,000 after expenses. So she would need to determine whether or not that would be the right amount for her to continue with her current business model. When you look at your income statement, you'll want to think about your net income and determine if you're making what you're worth. I highly recommend that you set up a calendar reminder and block out some time to review your income statement at least once a quarter. So what happens if your income statement shows that you're not bringing home what you're really worth? This is when you need to analyze what your income statement is telling you. To help you dig into it, I've put together some questions to ask yourself. First, what are your biggest expenses? Make a list of these and figure out where can you cut things down. Next, are your expenses actually pretty low, but you're just not bringing in enough profit to make up for them? If so, make a list of ways you can increase your sales. You should also think about whether you should raise your prices. Finally, has your income been growing, shrinking, or staying the same over time? Determine which factors are causing changes and make a list of ways you can improve in those areas. Once you start looking at your income statements and really analyzing them over time, you can also determine your growth trajectory. This can help you make smart decisions about all aspects of your business, such as purchasing new equipment, paying for advertisements, hiring new employees, and developing new products or services. Even knowing you have a positive growth trajectory should be exciting enough for you to want to drill down into your income statements. To put it simply, understanding your income statement can help you figure out how to make more money while spending less. So make sure you take this time to do this on a regular basis. You owe it to yourself. In our next lesson, we'll take a close look at another important report, balance sheets.